There are many different variables that will determine what the interest rate will be on your mortgage, from the state of the economy to the credit cards in your wallet. Over the next few minutes, you're going to find out how mortgage rates are determined and how you can lower your rate with a few tricks. Let's start with how mortgage rates are determined. As with many other aspects of the economy, market forces are to thank, or blame. Specifically, the three major drivers of mortgage rates are stock prices, the labor market, and inflation. They each have their own relationship with mortgage rates, but in the end, it all boils down to where investors are putting their money. Typically, if inflation and the labor market are both strong, investors will move more into stocks, causing mortgage rates to rise. One of the biggest factors in determining your personal rate is your credit score. This number shows lenders how risky of a borrower you'll be with your mortgage payments. Another big factor is your loan-to-value ratio. This is basically how much you're paying as a down payment if you're purchasing, or how much equity you have if you're planning on refinancing. While income levels don't necessarily affect your rate directly, they work hand in hand with your credit score to determine what loan is going to be right for you. This is important because different products have different functions and requirements that will impact your rate. The property type which you are trying to purchase or refinance can also play into determining your rate. A primary residence is seen as low risk and will therefore get you a lower rate than something less reliable, like a vacation home or an investment property. One of the best ways to get a better interest rate is to raise your credit score. Aiming for 620 is a good start, but over 740 would be ideal. There are many things you can do to raise your score, such as staying up to date on all your payments, paying down any debts, or even contacting a credit repair service. Another strategy to score a lower interest rate is to increase your down payment. You can do this by saving money over time, taking money out of an IRA or 401k account, or in certain circumstances by using gift money. Finally, there's the option to lower your interest rate by paying points. 1 point is equal to 1% of your mortgage, so on a $100,000 loan, that would be $1,000. At closing, you would pay the $1,000 to lower your interest rate by a certain amount, usually 0.25%. I know some of these strategies can seem a little tricky if you've never tried them before, but our mortgage specialists are well-versed and ready to break them down for you and get you on an ideal home financing path. At Total Mortgage, we've helped thousands of buyers optimize their home financing needs over the 20-plus years we've been in business, and we're confident we can do the same for you. To learn more about how mortgage rates are determined and for an in-depth look at how to lower your personal interest rate, check out our free e-series listed in the links below. Thanks for watching, and be sure to like this video and subscribe to our channel for more resources from Total Mortgage.